to Aehr Financial. We're here to help you forge a stronger portfolio by hammering through the market's noise. And today, we are taking a sledgehammer to one of the most contradictory, one of the most polarizing reports I've seen all quarter. We're talking about Aehr Test Systems, ticker AEHR. Look, this is more than just an earnings report. It's a battlefield. On one side, you've got financials that look like a building that's been condemned. I mean, seriously, they're ugly. But on the other side, you've got a pipeline of new orders that looks like the blueprint for a brand new skyscraper. So our job today is to figure out if this company's structure is fundamentally sound or if it's about to come crashing down on investors. Let's get to it.
So this is the central question, right? This is the whole thing. It's a paradox, and it's what's splitting Wall Street right down the middle. How is it possible that the recent past and the near future for one company can look so incredibly, so radically different? You know, contradictions like this, they create massive opportunity, but they also create massive, massive risk.
Yeah, let's be blunt about this for a second. A report like this is a total minefield for the average investor. You look at one page, you see one set of numbers, and it's screaming, sell, get out now. You flip the page, and the next set of numbers is screaming, buy, this is the next big thing. It's whiplash. It's confusing. It's going to be volatile. And let's be honest, if you bet on the wrong story here, you are going to get absolutely wiped out. So which is it? Is the story the collapse, or is it the explosion? That's what I'm here to find out.
Exactly. And to figure that out, you can't just guess. You need a blueprint. So here's our plan of attack for today. First, we're going to start with a tale of two reports. We'll lay out exactly what these two conflicting stories are that are just tearing the market apart. Then we're going to grab our hard hats and go into cracks in the foundation, where we'll survey just how bad the damage from this last quarter really is. After that, we'll see if they can actually rebuild in Forging the Future, where we'll examine their blueprint for growth. Next, we'll fire up the AI growth engine to really understand the powerful technology that's driving this whole potential turnaround. Then we'll stress test their finances in the balance sheet fortress. And finally, we'll bring it all home, weigh all the evidence, and deliver the final verdict. All right, let's dig in. Okay, Section 1, the market's paradox. You know, in all my years of doing this, I've rarely come across a quarterly filing from a company of this size that tells two such wildly different stories. It's the kind of thing where you absolutely have to read beyond the headlines. You've got to dig past the summary tables to even get a hint of what's really going on here. One story is all about the past 90 days of performance. The other is about the next few years. And believe me, they could not be more different from each other. So here's the conflict boiled down to its simplest form. Over on the left, you've got what the market initially reacted to. This is the headline stuff. Revenue, profits, basically looking in the rearview mirror. And that story, to be frank, is a total train wreck. It's a story of shrinking sales and mounting losses. But then on the right, you have the story that the bulls are clinging to for dear life, the pipeline. We're talking about bookings and backlog. Now, these are the forward-looking indicators. They tell you what the company has actually been hired to build in the future. And that story, it isn't just good. It is a story of explosive, almost unheard-of growth for a company of this size.
Okay, so one's a horror story and the other is a fairy tale. I get it. But the question for any of us with money on the line is simple. Which one do you believe? Are you buying the ugly past or are you buying a beautiful promise? Because from where I'm sitting, promises can be broken.
And that's a completely fair point. To understand the strength of that promise, we have to start by getting our hands dirty and fully inspecting the damage. So let's move on and survey the Q3 results. We have to measure these cracks in the foundation. We need to understand the real risk here. At Aehr Financial, we don't just sweep bad news under the rug. We confront it head on. So let's start with the top line, the revenue. Okay, here it is. This is the number that sent a shockwave through the market. Third quarter revenue, just $10.3 million. Now, for a company that's supposed to be in the red-hot semiconductor testing space, especially with all the talk about the AI tailwind, a number this small is a massive red flag. It represents a huge contraction. It's a big step in the wrong direction. It shows a business that, for the last 3 months anyway, was actually shrinking.
Now, putting this number into context is where it really gets ugly. Just look at this year-over-year comparison. Revenue didn't just take a little dip, it fell right off a cliff. It's down almost 44% from this exact same quarter last year. And the bottom line? It's hemorrhaging. On a GAAP basis, the net loss ballooned by more than 5 times. But the real gut punch, the one that really hurts, is the non-GAAP number. You know, the one that management adjusts to try and make things look a little better. Well, they went from a healthy $2 million profit last year to a $1.5 million loss this year.
That is not just a bad quarter, that's a complete fundamental breakdown in profitability.
I mean, these numbers are just brutal. There's no other way to put it. A 44% drop in revenue and a swing from a solid profit to a pretty big loss? That's not a crack in the foundation. That looks like a wrecking ball just smashed through the main floor.
And it gets even worse when you drill down to the per share level, because that's what the street is really focused on. The GAAP earnings per share was a loss of 10 cents. Now look, Wall Street analysts, they knew it was going to be a weak quarter. They were prepared for that, but their consensus estimate was for a loss of only 5 cents. So Aehr didn't just miss expectations, they doubled the expected loss. That is the kind of miss that absolutely shatters confidence and forces the big institutional friends to just dump the stock. And hold on, I have to make a crucial point here. This isn't just one bad quarter, some kind of fluke. This slide right here shows that for the first 9 months of their fiscal year, their revenue is down from almost $45 million to just over $31 million. That's a sustained, long-term period of decline. The 9-month GAAP net loss, it went from just over $1 million to a staggering $8.5 million. So this is not an anomaly, folks. It's a trend. The foundation hasn't just developed a crack, it feels like it's been actively eroding for 3 straight quarters. How in the world are you supposed to build a skyscraper on top of that?
That is the perfect question, and it brings us directly to the other side of this entire story. You are 100% right, the past looks like a pile of rubble. But here's the thing, this company isn't trying to patch up the old foundation. It seems they are forging an entirely new one, out of much, much stronger materials. So we've surveyed the damage. Now, it's time to unroll the blueprint and see what they're planning to build.
So here's the crucial thing you have to understand. For a capital equipment company like Aehr, a company that builds big, expensive machines, revenue is actually a lagging indicator. It just tells you what they were able to build and ship in the past. The true measure of a company's health, the real predictor of future revenue, is the flow of new orders. We call those the leading indicators. And on that front, well, the story could not be more different. Just look at this number. Let it sink in. In the exact same quarter that Aehr reported a measly $10.3 million in revenue, they signed new, firm, contractual orders, what we call bookings, for $37.2 million of new equipment. Let me put that another way for you. For every $1 of product they managed to ship out the back door, they had nearly $4 of brand new orders coming in the front door. This isn't a small beat. This is a monumental, tectonic shift in demand for their products. And this right here perfectly illustrates the point. It's a metric called the book-to-bill ratio. You just take the new bookings and divide by the revenue. Theirs was over 3.5. Now, for context, a ratio over 1 is considered healthy. It means you're growing. A ratio of 1.5 is considered very, very strong. A ratio of over 3.5 is almost unheard of. It's like sending up a signal flare to the entire market that says demand is absolutely overwhelming your current ability to produce. It tells us the problem isn't a lack of customers. The problem is a giant backlog of work just waiting to get done.
Okay. That number is impressive. I'll give you that. But what exactly are these bookings? How solid are they? Can a customer just pick up the phone and cancel a $10 million order if the economy takes a downturn? I mean, is this real concrete demand, or is it just a bunch of fancy placeholders that could vanish tomorrow?
And that's the key risk, right? We have to address it. So these aren't flimsy purchase orders for widgets. These orders are for large, complex, custom-built systems with very long lead times. They're often tied directly to a specific customer's factory expansion plans. So they are much harder to cancel. And this is where the backlog comes in. At the end of the quarter, their official backlog of orders was $38.7 million. But get this. They received so many new orders right after the quarter officially closed that the company reported what they call an effective backlog of $50.9 million. That is almost 5 times their quarterly revenue, all locked in. It's a pipeline of future revenue that is already signed, sealed, and just waiting for delivery. And this incredible visibility into the future is precisely why management can come out right after reporting a disastrous quarter and guide with such unbelievable confidence. Just look at this guidance. They're telling the market they expect full-year revenue to hit the high end of their $45 to $50 million range. Will you do the math? That implies a fourth quarter that is absolutely massive. They expect second-half bookings to be at the high end of a $60 to $80 million range. That's just enormous. And they reaffirmed their second-half revenue guidance. A management team does not do this. They do not stick their necks out like this unless they have a crystal clear line of sight into their production schedule and their customer commitments. They're basically telling the market the storm has passed and the build-out is beginning now. All right, I have to say, the order book is strong. I'm starting to see the blueprint you're talking about, but I'm still stuck on the why. What is causing this sudden, massive surge in demand? It can't just come from nowhere. You can't just decide to build a skyscraper on an empty plot of land. There has to be a real economic engine underneath powering the whole thing. What is it?
That is the perfect question. And now we can move on and see how this all connects. It is time to go down to the engine room and look at the actual technology that's driving all this demand. And it really all comes down to solving a very critical and very expensive problem for some of the biggest names in the entire tech industry.
Okay, so the core technology here has a fancy name. It's called wafer level burn-in, or WLBI. Let me just break this down in simple terms. The AI processors that are being built today are unbelievably complex. They aren't just one single chip anymore. They're more like a small city on a silicon package, containing multiple smaller chips called chiplets, high bandwidth memory, all sitting right next to each other. Now, if just one of those tiny little chiplets fails after you've spent a fortune packaging them all together, you have to throw the whole thing away. The entire very expensive processor is garbage. WLBI is basically a super advanced quality control system that cooks and stress tests the entire silicon wafer at once, finding and weeding out the weak chips before they ever get put into that expensive package. It's all about preventing catastrophic and very costly yield loss. And hey, you don't have to take my word for it. This is a direct quote from the CEO, Gain Erickson, from the earnings call. And this just perfectly illustrates the economic value proposition for their customers. It's a simple calculation for them. Is it cheaper to buy Aehr testing systems, or is it cheaper to throw away millions of dollars worth of advanced AI chips? As these chips get more complex and a lot more expensive, the answer to that question becomes clearer and clearer. This technology isn't a luxury anymore. It's fast becoming a necessity for any manufacturer operating at the cutting edge of AI hardware. Now, the other huge growth driver here is something called silicon photonics. This is another absolute game-changing technology. In essence, it's all about replacing the old-school copper wiring on and between computer chips with tiny little beams of light. Why? Because light is so much faster and way more energy efficient for moving gigantic amounts of data. And in an AI data center where you might have thousands of GPUs, all needing to talk to each other at once, the speed and efficiency of those connections is absolutely everything. Silicon photonics is the tech that makes that possible, and of course, these special optical chips also need to be rigorously tested to make sure they'll work reliably for years, and Aehr is a key player in doing that testing.
Okay, look, silicon photonics is a huge buzzword. I hear it all the time. And the wafer-level burn-in thing, it makes logical sense. But is AHR for real? Are they a real player here? Or are they just some small niche company that got lucky with a couple of orders? Do we have actual proof that the big dogs are adopting their tech for these critical, Mission Impossible type applications?
This is the proof. You want proof? This is it. This isn't some theory. Look at the actual customer wins they announced just in this last quarter. A production-level order from their lead AI processor customer, a brand new major customer win for silicon photonics, a follow-on order from their existing lead customer in silicon photonics, which is huge because it shows the tech works and the customer came back for more, and a production win for a next-generation AI accelerator from a lead hyperscale customer. And we all know that's code for one of the biggest tech companies in the world. These are not small R&D orders for a lab. These are production wins from the biggest, most advanced companies on the planet. They are validating Aehr's technology with their own money, and they're writing multi-million-dollar checks to prove it. Okay, I have to admit it. The demand story is getting a lot stronger. That customer list is very impressive. But that brings me right back to those cracks in the foundation. They lost $3.2 million last quarter. Now, to actually build and deliver a $50 million backlog, they are going to need to spend a ton of cash up front on inventory, on hiring people, what we call working capital. So can they actually afford to build this skyscraper, or are they going to run out of money halfway up the tower, leaving investors holding an empty bag? How strong is their balance sheet, really? That is the most critical question of all. And honestly, this might be the single most surprising piece of data in the entire report. You'd expect them to be burning through cash, right? Well, despite burning cash on an operating basis, and despite reporting a significant loss, Aehr's actual cash position increased during the quarter. It went from $31 million at the end of November to over $37 million at the end of February. Now, this is probably due to things like collecting cash from previous sales, but the bottom line is what matters, and it's crystal clear they are not bleeding cash uncontrollably. They have built a balance sheet fortress. They have zero debt and a growing pile of cash. This gives them the capital, the raw material they need to fund this production ramp up and turn that massive backlog into massive revenue, all without having to go back to the market and dilute shareholders by raising more money. So, that brings us to the final weigh-in. We've inspected the foundation, we've reviewed the blueprint, we've checked the engine room, and we've confirmed the financing is in place. It is time to put all the pieces together and deliver the final verdict. Is Aehr Test Systems a once-in-a-generation opportunity to get in on the ground floor? Or is it a dangerous value trap just waiting to spring on unsuspecting investors? Okay, let's lay it all out on the table. The bull case is entirely forward-looking. It's built on that bookings explosion, the massive backlog that gives them incredible revenue visibility, that insane book-to-bill ratio showing demand is off the charts, and of course, their critical role in the two hottest sectors in all of tech, AI and silicon photonics. You top that all off with a fortress balance sheet to fund the whole thing. The bull sees a company that's right at an inflection point, about to transform from a small player into a key, critical supplier.
But the bear case is rooted in the ugly reality of today, not some promise of tomorrow. You've got a revenue collapse of over 40%, a big swing from profit to a significant loss. And what about the execution risk? That's huge. Can a company this small really ramp up its production that fast without having major quality control issues? And you know their profit margins are going to be under intense pressure in the near term as they spend heavily to try and meet this demand. The bear sees a company that's choking on its own growth, writing checks with its mouth that its factory might not be able to cash.
So here is the iron financial verdict. The bear case is 100% valid. You cannot and should not ignore those terrible quarterly numbers. But it is a snapshot of the past. The weight of the evidence, the hard contractual evidence of the bookings and the backlog from the biggest and smartest companies in tech, it points overwhelmingly toward the bull case. The financial damage we see today looks like the necessary cost of retooling your factory for a massive new wave of business. It's temporary. The leading indicators tell us the foundation isn't actually cracked. This was just the demolition phase before the real construction begins. The risk has now shifted. It's no longer a question of if there's demand. It is now a question of execution.
And that is the final thought we're going to leave you with today. The market has been given the architectural drawings for a skyscraper. It's this $50 million backlog. The financing for the project is secure, with $37 million in the bank and no debt. The location, smack in the middle of the AI and data center construction boom, is prime real estate. So the question is no longer about the plan. It is now about the construction crew. Does management have what it takes to execute? Can they ramp up their manufacturing, maintain their quality, and deliver on this massive, massive promise? That is the billion-dollar question that will determine whether AEHR stock builds a new skyline for investors or if it just remains a hole in the ground. Thanks for watching Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.